Okay, so now we are going to be taking a look at Chapter 8. Let me get to the answer key and share my screen. There we go. So we're going to look at some of the problems and exercises that were assigned as practice. So let's take a look on page 446. Costs included in inventory. Reagan Corporation is a wholesale distributor of truck replacement parts. Initial amounts taken from Reagan's records are as follows. So this is inventory at December 31st based on a physical count of goods in Reagan's warehouse on December 31st. And their accounts payable also. Where is that 1 million coming from? Oh, okay. It's at the bottom. So the list you see there is their accounts payable. The dollar amount of $1,250,000 is their inventory balance. And those are the companies, Baker, Charlie, Dolly, Eagler, Fool, and Greg, that this company owes money to. And then we have their sales for the year. So what we need to do is the requirements, prepare a schedule of adjustments to the initial amounts if required, using the following format. The one listed below there. Show the effect, if any, of each of the transactions separately, and if transactions would have no effect on the amount shown, state none. So here's our additional information. Parts held by Reagan on consignment from Charlie, amounting to $155,000, were included in the physical count of goods in Reagan's warehouse and in accounts payable. So the question is, does Reagan own them? And they don't. They're holding them on consignment for Charlie. So that should not have been included either in inventory or accounts payable. So take it out. In 2, parts totaling $22,000, which were purchased from Fool and paid for in December, were sold in the last week of the year and appropriately recorded as sales of $28,000. The parts were included in the physical count of goods in Reagan's warehouse because the parts were on the loading dock waiting to be picked up by the customer. What do you think? Don't include them in inventory. They were properly reported as a sale. Remove them from inventory. So the sales number doesn't need to be adjusted because the sale was properly recorded, and this has no impact on accounts payable. Number 3, parts in transit, so on their way on December 31st to customers, were shipped FOB shipping point on December 28th, amounted to $34,000. The customer received the parts on January 6th of the following year. Sales of $40,000 to the customers for the parts were recorded by Reagan on January 2nd. So the question is, when was this sale really? And it's when the goods transferred I'm not liking my answer. Oh yeah, okay, when the goods transferred. So it doesn't tell us if they took these out of inventory, and they should be included in sales. This was a sale, and if these were not deducted out of inventory, they should be now. And it doesn't tell us. Let me read it again. I would think that if they recorded the sales of $40,000, that's when they reduced inventory, was January 2nd, and they shouldn't have. They should have recorded them on December 28th. So I'm not agreeing with your answer key there. Retailers were holding goods on consignment from Reagan, which had a cost of $210,000 and a retail value of $250,000. Well, they're not telling us. Oh, okay. So these goods, okay, so in part 3, before I go to part 4, I have to change my answer there. Because when we look at the $1,250,000, that was the physical count, okay? So in part 3, those goods weren't included in the inventory balance of 1,250,000 because they aren't here anymore. And they shouldn't have been included. That's why we didn't need to adjust that. But in part 4, our inventory balance should be 210,000 higher. The inventory balance, the initial amount, is for stuff that was counted in our warehouse. We own the goods that are on consignment from Reagan. So there's companies out there that have goods we own sitting on their shelves that are going to sell them for us. We didn't include that in our count. They should be added in. Okay, goods were in transit from Greg to Reagan on December 31st. The goods were in transit from a supplier to Reagan, to us. The cost of the goods was $25,000 and they were shipped FOB shipping point on December 29th. So on December 31st, they were not in our warehouse, so they were not included in our original inventory account. The question is, did we own them on December 31st? And the answer is yes. The buyer, Reagan, that's us, owns the goods while they're in transit because they were shipped FOB shipping point. And we should also increase accounts payable because we owe on those. A freight bill in the amount of $2,000 specifically relating to merchandise purchased in December, all of which was still in inventory at December 31st, was received on January 3rd. The freight bill was not included in either the inventory or in accounts payable. Well, it should have been, because those are costs related to the inventory from last year. All the purchases from Baker occurred during the last 7 days of the year. These items have been recorded in accounts payable and accounted for in the physical count at cost before discount. Reagan's policy is to pay invoices in time to take advantage of all discounts, adjust inventory accordingly, and record accounts payable net of discounts. So let's see. Charlie, Fool, 3 amount to 34,000. Okay, good. Good stuff. So Baker, we owe $265,000 to, and that's on page 446. One more time. All the purchases occurred during the last 7 days of the year. These items have been recorded in accounts payable and in the physical account at cost before discount. Reagan's policy is to pay invoices in time to take advantage of all discounts, adjust inventory accordingly, and record accounts payable net of discounts. So the question is, did they? And we're going to assume they didn't. So because, well, we don't even have to assume that because it tells us in line 2, all the purchases from Baker were recorded at cost before discount. And the norm is for them to record their inventory and accounts payable net, meaning they assume they're going to take all discounts. So the amount they owe to Baker is $265,000. Take a 2% discount. Reduce inventory and accounts payable by $5,300. It should have been recorded $5,300 less. So due to these items, the true value of inventory, $1,304,700. The true amount we owe in accounts payable, $866,700, and the true amount of sales, $9,040,000. So you can see that we just don't take an account balance at face value. We must look at these additional items that might be in transit or have occurred at the end of the year to see, are we truly recording them in the proper accounting period? So that was a great exercise in determining that. Moving along, I think the next one, I think P813, I'm going to wait on. That's a dollar value. Like, yeah, let's wait on that one. Let's go to exercise 817, and then we're going to look at exercise 819. Sorry if I'm making you dizzy here. Just bear with me. So here's 817. I think that's the beginning. Yes. Okay, so let's find out what the requirements are for that one and take a look at the answer. So remember, try these on your own before you listen to this, right? The following information is taken, this is on page 441, I'm sorry. The following information is taken from the inventory records of the C&B company for the month of September. So they began the month of September with 5,000 units at $10 each. They made purchases on September 7th and September 25th, and they had 2 sales, one on September 10th and one on September 29th. At the end of September, there were 7,000 units on hand. Now we're going to assume CMB uses a periodic inventory system and the average cost method. So remember, periodic, we are determining all the cost of goods sold at one day for the entire period. We're not removing inventory as we sell it. So how do we approach this? Well, when it's an average, the first thing we want to do is determine the total cost of everything we could have sold. So we'll start with beginning inventory. There were 5,000 units, $10 each. The total value of beginning inventory was $50,000. We will then add all purchases for the month. 3,000 units at $10.40 each and 8,000 units at $10.75 each. So the total purchases were $117,200. Add the total purchases to the beginning inventory. So the cost of everything that could have been sold, $167,200. The total number of units that could have been sold are the 5,000 from beginning inventory plus the 3,000 and 8,000 in purchases, or 16,000. So we average, we take 167,200 divided by 16,000 units, the total cost of everything divided by the total quantity. So the cost per unit is $10.45. So to determine ending inventory, we will say how many units are left in the periodic system. Remember, we go out and count them. There's 7,000 left. Well, we will value them at the average cost for each of $10.45 each, or $73,150. Now, we could take and subtract the ending inventory from cost of goods available for sale. Remember, $167,200 is the cost of everything we could have sold. Some of it we sell, some of it is still here. The part that's still here, is valued at $73,150. Then the cost of the goods that were sold is the difference of $94,050. And you could double check that. How? Well, you had 16,000 units you could have sold. You have 7,000 left. So you sold 9,000 units. Multiply that by $10.45 per unit, the average cost. In the periodic system, we look at the whole year at one time. That's the average cost. But what happens if you have the perpetual? That's a little different because we're removing inventory as we sell it. So let's take a look. Remember, we use like a perpetual inventory record to keep updating our inventory as we buy more and sell more. And we update the average cost per unit each time we buy more inventory. So we start with 5,000 units at an average cost of $10 each. That should not be in the purchases because you didn't purchase stuff, right? That should just be in the balance. But what happens when you purchase more units? Well, you buy 3,000 on September 7th for $10.40 each. Or a total cost of $31,200. What we do is we say, okay, and you could do this in the balance area even, and really, that's probably where it should be. So I'm going to put it over there as well. We say, what's the cost of everything we purchased and we have? What's the cost of all the stuff we have? Well, the 5,000 units that were in beginning inventory cost $50,000. These new units cost $31,200. So our total cost, $81,200. How many units do we have after this purchase? Well, we had 5,000 before. We added 3 more. So we're at 8,000 units. Divide the 8,000 units into the total cost of $81,200. Your new average cost per unit is $10.15. How does this impact us? Well, when you sell on September 10th, which is our next chronological date, 4,000 units, remove them at their average cost of $10.15 each for a total cost of goods sold of $40,600. So that's how much we would figure out to debit cost of goods sold and credit inventory for when we make that sale. Because remember, we have to make that journal entry the day we make the sale under the Perpetual system. What's left at the end of September 10th? Well, we had 8,000, we sold 4,000, so there's still 4,000 left at an average cost of $10.15 each. When we purchase more goods on the next date of September 25th, and I'm also going to put this over here, we buy 8,000, they now cost $10.75 each for a total cost of $86,000 for this purchase. So how much does all of our inventory cost as of September 25th? Well, $40,600 from the prior balance plus $86,000 will give us the $126,600 total cost of all of our inventory. 4,000 units before this purchase plus 8,000 in this purchase gives us 12,000 overall units. Divide the 12,000 units we now have into the total cost of those units of $126,600. The new average cost per unit, $10.55. So each time we buy more inventory, we must update the average cost per unit so that when we make that sale on September 29th, we remove 5,000 units, but we remove them at their new average cost of $10.55. So we would be debiting cost of goods sold and crediting inventory for $52,750. Then our ending inventory would be what's left. We have 12,000. We just sold 5, so we have 7,000 left that have an average cost of $10.55 each. So the inventory balance on September 30th, $73,850. That's what's left. Our cost of goods sold balance would be the $40,600 plus $52,750, or $93,350. Average cost, it's just a different system, Perpetual. Periodic, we wait till the end of the year, find a one average cost and determine what was sold, what's left, and that's how we value the inventory. Perpetual, we're constantly updating for the purchases and sales, so it's just a different approach. You're still averaging them. So that's how we would use the average cost method. Now we're going to move to exercise 819, which deals with Fifo and Lifo. So let's take a look at requirement 1. In exercise 819, it starts to be more efficiently manage its inventory. Trainer Corporation maintains its internal records using first in, first out, Perpetual inventory system. So they're going to move their oldest items out of their inventory balance when they're sold, when something is sold. So here's some transactions related to its inventory. The first thing we're going to do is determine the amount Trainer would calculate for ending inventory and cost of goods sold if they used a Perpetual inventory system. So that's what you're seeing in front of you here. They purchase on January, what the heck? Hold on. I'm looking to see. Okay. Drives me a little crazy when they do this. I'm going to pull up a Perpetual inventory record. And I will share that with you. Let me get back into my Zoom. Where's my Zoom meeting? Let me stop sharing there And go in and share an Excel spreadsheet. There we go. And we'll come back to that answer key. I'm just not liking the way they presented it. So if we use that perpetual inventory record like we did for the average cost, just bear with me while I do some updating here to this. We have our purchases column, and then we account for quantity, unit cost, and then the total cost. Whoops. We have a separate column for each whenever we purchase something. Then whenever we sell something, we do the same thing. We'll list how much we sold, how much we're removing it at per unit, and then overall total cost. And then we determine an inventory balance after each transaction by quantity, unit cost, and total cost. Okay, so let's take a look at the transactions for exercise 819. January 1, the company starts with 20,000 units, whatever they sell. So I'll say it's 20,000 books. It cost $12.20 each. So if we multiply the 20,000 times 12.20, $244,000. Let me make those dollar signs, and that's good. February 12th, the company purchases 70,000 units. Now they pay $12.50, 70,000 books. The books now cost $12.50 each. Multiply the 70,000 times $12.50. Excellent. Just going to make those dollar signs so that they're more understandable. So after this purchase, we must update the inventory balance. How do we do that? Well, we say, what's our total inventory now? 20,000 at $12.20 each, and then 70,000 that they cost $12.50 each, or 875,000. Okay. So as we purchase more, we layer them because we want to know our oldest to newest inventory. April 30th then, we're doing a perpetual inventory record, FIFO. So we're going to come over and say, okay, we sold 50,000 units. Under FIFO, first in, first out, what did we sell? Well, the assumption is the first items in inventory are the first to be sold. So 20,000, the ones that were 20,000 that cost $12.20, we remove those. Those are assumed to be sold. And then the remaining 30,000 then must have cost $12.50 each. So under this method, the total cost of goods sold would be those two amounts added together. What's left? Well, these 20,000 have been removed, gone, and 30,000 of those are removed. So there's 40,000 left that cost $12.50 each under FIFO. Oops, so you want to multiply those out. And that's your ending inventory after that sale. Go to the 22nd of July. Now they're purchasing 50,000 units. These cost $12.80 each. So we'll multiply that out. Update our inventory balance. Notice when we're buying stuff, we're just adding it to the existing layers. And if you want to put a total, you can, but you don't have to. We just want to know oldest to newest, right? Then on September 9th, 9/9, Lori, okay, we sold 70,000 units. Again, what's the new or the oldest items in inventory? The first one's in. Well, the 40,000 that cost $12.50. So those 40,000 will be removed first. We sold a total of 70. So the other 30,000 are from the ones that cost $12.80 each. We have to remove a total of 70. We can't go 70 cost $12.50. No, only 40,000 cost $12.50. Can't remove more than you have in that category. So then you go down to the next purchase. So for this sale, your cost of goods sold would be $884. What's left? 20,000 of the books that cost $12.80. And I'll just multiply that out, 256,000. On November 17th, We're going to purchase 40,000 more books. These cost $13.20 each. Multiply those out. Add them to your inventory. Oops. Finally, December 31st. The ending inventory on hand is $60,000. Oh, or 60,000 units. Yep. And that's how many are there. So we didn't sell anything else or buy anything else from November 17th moving forward. So under requirement 1, the ending inventory, if we use Fifo, is 784,000. Cost of goods sold would be the 619,000 plus the 884,000, or 1,503,000. Okay. That's if we used Fifo to remove our inventory. Let's see what happens if we used Lifo, which is requirement 2. And just give me a timeout to grab a drink. Sorry about that. Oh, I'm going to be losing my voice shortly. Now, in requirement 2, it says, now pretend that they use Lifo. And it's a periodic system. Yo. We don't need a perpetual inventory record then. Remember, when you're using Lifo, and I think I'm going to switch back to our answer key because it'll probably be in more. Let me stop sharing a second and go to our answer key. There we go. It'll be more in line with what you need. We list all of our purchases for the year. So we begin inventory with 20,000 units at $12.20 each. Then we show only the purchases and we add them in. So the 70,000 that were purchased on February 12th, the July 22nd purchase of 50,000 units, and then the November 17th purchase of 40,000 units. And we multiply them by how much their unit costs were to get a total cost. So the company started with 20,000 units. It added 70, 50,000, and 40,000 to get 180 units it could have sold. 180,000 books it could have sold, and those 180,000 books cost $2,287,000. Lifo inventory says, okay, periodic system. How many did you sell? How many are still here? Well, we know our sales. We sold 50,000 on April 30th. September 9th, we sold 70,000. So we sold a total of 120,000 of those books. So what we would do is with Lifo, we would go backwards. Cost of goods sold, and you could write this down because, and I'll see if I could add it in here. Let's see if it lets me add some stuff without crazy formatting changes. Cost of goods sold, remember, you would remove newest to oldest. So the first 40,000 we bought at $13.20, they're sold. The next 50,000 that we sold, purchased at $12.80, they're sold. Then of the 70,000 that were sold, I'm sorry, 70,000 there, we sold 90 so far. We need 30,000 more to be removed or sold, which would be 30,000 of the ones that cost $12.50. So we would multiply each one of these out. So 528,000, whoops. Then we have the 50,000 at $12.80, 640,000. Then we have the 30,000 at $12.50. So multiply those out. And that's 375,000. So you add those up, the 528 plus the 640 plus the 375, cost of goods sold is what we see up in the top there, but that's how we can get that amount. So total cost of goods sold would be $1,543,000. Okay. What's left in inventory? Because in the question they said, determine ending inventory and cost of goods sold. Well, what's still left? What didn't we remove? Of these 70,000, we removed 30, right? So 40,000 of those are still on hand according to Lifo, and the 20,000 in beginning inventory are still on hand. So we add those totals together, ending inventory under the periodic system, 744,000. And if you take the total cost of everything you could have sold minus the ending inventory of 744,000, that will give you what we computed cost of goods sold to be. Okay, but that's how you actually calculate it. Now, in part 3, it says, determine the amount Trainer would report for its Lifo reserve at the end of the year. Well, under the Perpetual Fifo, which is what their current balance would be. Remember, they use that for internal reporting. So that's what the balance in their inventory account would be, 784,000. But Lifo is what they want to report on their financial statements. The balance of inventory, Lifo, 744. Let me just flip back over. I'm going to stop sharing this and I'll go over to the, if it lets me. Come on, where are you? Let me get back to my share. There we go. Okay. Share my Excel spreadsheet with you. Come on. All right. There we go. Remember, ending inventory under Fifo for internal purposes was 784,000. I'm going to go back to my word here. For external purposes, Lifo said, no, 744,000. So the difference is what we put in the Lifo reserve account. So on December 31st, we'll debit cost of goods sold and credit that contra inventory account Lifo reserve. Now, where are these numbers coming from? Well, I forgot to read requirement 4 that says, what if your Lifo reserve currently has a $10,000 credit balance in it? That's the balance in there. Well, we need it to be 40,000. So that's what you're determining in requirement 3, what the balance must be in the Lifo reserve account at the end of this year. So you have to make a journal entry to get it to that point. And the Lifo reserve will normally have a credit balance in it, because Lifo ending inventory is almost 99% of the time less than Fifo ending inventory. So credit the Lifo reserve 30,000, debit cost of goods sold. Okay. The final problem we're going to look at is problem 8-13. This is on page 451. Let me pull up my answer key. So this is dollar value Lifo. You're going to see this in action. I'm recording. In problem 8-13, we are looking at, what's up? I'm not having office hours now, so just tell him I'll talk to him. Oh, he's going to ask. Okay. Forgot about it. No, that's okay. Okay. The final problem is dollar value Lifo. Sorry, I got interrupted here. I hope you guys can still hear me. There we go. Okay. Exercise problem 8-13. Here we go. Okay, I'm really sorry about that, guys. I'm going to get back to sharing there we go. I'm in my office and I forgot somebody was coming in for a makeup test, and I was like, I'm not doing office hours right now because I have my door closed, and here it was my fault. So, oh well. Okay, you don't want to hear my problems. Moving along, problem 813. On January 1st, 2021, the Taylor Company adopted the dollar value Lifo method. The inventory value for its own inventory pool on this date was $400,000. Inventory data for 2021 through 2023 are as follows. 12/31/2021, there's a 441,000 ending balance in inventory. 12/31/2022, 487,200, and 12/31/2023, 510,000. Now, remember what we're doing here. We're trying to ensure that our Lifo system is truly working. And remember what Lifo wants to accomplish. It wants to record as much of the inventory as an expense in cost of goods sold and the lowest amount in the inventory account. That is the purpose of Lifo. Sometimes when we start liquidating our inventory, some of the older costs get expensed, and that hurts the objective of Lifo. That means our expense is less when we want it to be more. So let's take a look here. How do we proceed? Well, first of all, we need a base year, and you could see our very first date is 1/1/2021. That's our starting point. That's our base year amount, meaning our inventory should never go really below 400,000. Okay, because that's our starting point. So now each year, here's what we're going to do. We're going to say, well, what's the current value of our inventory at 12/31/2021 amounts? 441,000. Let's pull out price increase out of that 441,000. Well, how do we do that? Well, we need to know how much prices went up this year. Oh, 5%. So what we're doing is we're restating the end of this year's inventory at the beginning of the year's costs, how much it would have cost as of 1/1, 420,000. So why is our inventory higher? Is it because prices went up, or is it because we purchased more? And in this case, when we're comparing our inventory at the same level, the same costs, 400,000 to 420, really our inventory increased $20,000 during this year. So only $20,000 of it should be listed at current year costs. The first 400,000 should be at our 100% year. The next 20,000 of it should be valued at 1.05 because that's how much it increased quantity-wise this year. Because we're comparing the cost of our inventory as if it was at base year amounts. So in dollar value Lifo, we'll add those two together and we'll value our inventory at 421. Remember what the current balance of it is in our T account, 441,000. Oh no, it should be at 421,000. That's the lower amount. You see how it pools and only it provides us with that lowest inventory amount. Go to the next one. 12/31/2022, our current inventory balance is 487,200. Well, we want to restate that. How much would that same inventory have cost us if we bought it 1/1/2021? Well, pull out the price increase, divide it by 1.12. So if we purchased that inventory on 1/1/2021, our base year, it would have cost us 435,000. So how much did our inventory really increase? Well, it increased 20,000 last year and 15,000 this year. That's the quantity it increased. So we're only going to base our cost of our inventory for each year by the quantity or dollar value of the quantity it went up. So again, how do we value 2022? 400,000 base year times 100%. The next 20,000 is valued at 1.05 because that's the increase from last year at last year's prices. And then this year's increase is 15,000 at this year's prices. So multiply it by 1.12, the $15,000 quantity increase. Add them all up. So right now, our inventory balance on our inventory account is 487,200. Oh no, it should be at 437,800. And we'll make a journal entry to get it there. So we'll expense more and truly remain in a LIFO atmosphere. Final year. Take the 510,000 current balance divided by the price increase. We're restating inventory as if it was purchased on 1/1 of 2021. Now in this case, take a look. The inventory quantity actually decreased from last year to this year by 10,000 of it. How do we account for that? Well, we go 400,000 as our base year times 100%. The next 20,000 was the increase for the second year, 1.05. We don't show the 15,000 as a positive amount last year and then a negative. No, we start peeling off that 2022 layer and we say, okay, our increase is no longer 15,000. It's only going to be 5,000. Okay, so 400,000 plus 20 plus 5, and we're going to keep it, the price index, at the 2022 amount of 1.12. So instead of having 15,000 at 1.12, we're going to have 5,000 at 1.12. We never regain that 10,000 back, and we won't have a layer for 2023 because it didn't add. It started taking away from a prior year's layer. So what's our inventory balance at the end of this year using dollar value LIFO? Wow, 426,600. On our books, it says 510. Look at how much of a difference. So what we're going to do is expense all that difference, truly having the LIFO effect as it was intended. And that's why we use dollar value LIFO. It's just a good way for us to achieve LIFO. Highest cost, lowest inventory value. Okay, so that's where we're going to stop, and hopefully you had a nice flavor for the different components of this chapter. Please post any questions you have on the discussion board, and I do apologize for that interruption.